Homeowners in California and Florida are facing something that used to be rare: insurance companies refusing to cover their homes at all. This is not a small, local issue. It is happening at a scale large enough to threaten the stability of both states' housing markets, and the reasons behind it are different in each state, even though the outcome looks similar. In California, the core problem is wildfire risk combined with a decades-old insurance law. In 1988, California voters passed Proposition 103, a ballot measure designed to prevent insurance companies from overcharging drivers and homeowners. It required insurers to get state approval before raising rates, and it based those rate calculations on historical losses from the past 20 years. At the time, this seemed like a reasonable way to protect consumers from arbitrary price increases. For years, it worked roughly as intended. The problem is that Proposition 103 also restricted insurers from using forward-looking wildfire catastrophe models, the same kind of predictive risk modeling that is already allowed for earthquake insurance in California. These models attempt to project future losses based on current conditions, like drought severity, vegetation density, and building materials, rather than relying only on what happened in the past. Without access to this kind of forward-looking modeling for wildfire risk, insurers in California have had to price policies based mostly on historical data, even as wildfires have grown larger and more frequent than that historical data would predict. When insurers cannot charge a rate that reflects the risk they believe they are actually taking on, some of them stop offering new policies in high-risk areas, and some leave the state entirely. Several major insurers have done exactly that in recent years. Chubb announced in 2021 that it would significantly reduce homeowners' coverage in California, citing wildfire risk and the state's insurance regulations. Farmers Insurance Group began limiting new coverage in 2023, and one of its subsidiaries withdrew from the state completely. Nationwide's private client division told California it would stop renewing all of its homeowners' policies in the state by June 2025. These were not small regional insurers. They were large, well-established companies choosing to reduce their exposure in one of the biggest insurance markets in the country. When private insurers pull back, homeowners who cannot find coverage elsewhere are pushed toward California's FAIR Plan, a state-created insurance program originally meant to be a small, temporary safety net for a limited number of high-risk properties. It was never designed to be a primary insurer for a large share of the state. But as private companies have retreated, the FAIR Plan's policy count and financial exposure have grown enormously. By late 2025, the FAIR Plan's total liability had climbed to nearly $700 billion, more than double what it had been just 2 years earlier. After the Los Angeles wildfires in January 2025, the FAIR Plan faced an estimated $40 billion in claims, and insurance companies operating in California were hit with a $1 billion assessment to help cover the plan's losses, because state law requires them to help fund it if it cannot pay its own claims. This creates a difficult cycle. The more insurers leave, the more pressure falls on the remaining insurers and the state-backed plan, which in turn makes staying in the California market even less appealing for private companies. In response to this pressure, California's insurance commissioner introduced new regulations allowing insurers to begin using wildfire catastrophe modeling, but only if they commit to writing more policies in the high-risk areas they had been avoiding. This is a significant shift from how the state operated for more than 3 decades, and it reflects how serious the availability crisis had become. Whether this change will be enough to bring major insurers back to full participation in the state is still an open question, since expanding modern risk modeling is a recent development and its effects will take time to show up across the market. Florida's insurance crisis shares some surface similarities with California's, since both involve insurers retreating and homeowners relying more heavily on a state-backed plan. But the underlying causes in Florida are different, and hurricane risk alone does not fully explain it. Florida does face frequent, severe hurricanes, and storms like Hurricane Ian in 2022 caused enormous damage, with damage estimates in the range of $113 billion. But according to researchers who have studied the market closely, hurricane damage is not the single biggest driver of the crisis. A large share of Florida's problem comes from litigation. Florida accounts for roughly 9% of homeowner insurance claims filed nationwide, but at one point accounted for close to 79% of all property insurance-related lawsuits filed in the entire country. That is a striking imbalance, and it points to a legal and financial dynamic specific to Florida, not simply a weather problem. Part of this came from a practice called assignment of benefits, where a homeowner could sign over their right to an insurance claim to a third party, such as a roofing or repair contractor. This was originally intended to make repairs easier to arrange after a storm. In practice, some contractors and law firms used assignment of benefits agreements to inflate claims and file lawsuits against insurers, particularly because Florida law for many years required insurance companies to pay the policyholder's attorney fees if the case was decided in the policyholder's favor. This created a strong financial incentive to sue, since a law firm could pursue even a small, disputed claim with little financial risk to itself. Insurance industry researchers have estimated that Florida insurers paid billions of dollars in legal costs fighting these claims, on top of the underlying cost of the damage itself. This litigation environment pushed Florida insurers into sustained financial losses, even in years without a major hurricane making landfall. Some smaller Florida-based insurers became insolvent and were shut down by state regulators. Others, including national companies, chose to stop writing new policies in Florida or withdrew from the state altogether. As with California, the customers left behind were increasingly funneled into a state-backed insurer of last resort, Florida's Citizens Property Insurance Corporation. Citizens was never intended to be one of the state's largest insurers, but its policy count roughly tripled between 2018 and its peak in the following years, reaching more than 1.4 million policies at one point, a scale far beyond what a true last resort insurer was originally meant to carry. Reinsurance costs added further pressure. Reinsurance is essentially insurance that insurance companies themselves buy to help cover the cost of catastrophic, large-scale losses. As global reinsurance prices rose sharply, in part due to large-scale disasters worldwide, those higher costs were passed down to Florida homeowners through higher premiums. Some smaller insurers reported being unable to obtain reinsurance at any price, which meant they could not legally continue writing new policies at all, since insurers are required to maintain enough backing capital and reinsurance coverage to handle a major catastrophe. Florida lawmakers responded with a series of legal reforms starting in 2022, including eliminating the one-way attorney fee rule that had encouraged so much litigation and restricting assignment of benefits agreements. These changes appear to have reduced the volume of lawsuits significantly. According to Florida's insurance regulator, the share of closed claims involving litigation dropped from roughly 1 in 4 in 2022 to under 9% by 2024. Some insurers have since filed for modest rate decreases, and a small number of new companies have entered the Florida market. But premiums remain far above the national average, and many homeowners are still working through the effects of years of instability. The scale of insurer instability in Florida during the crisis years was significant. In mid-2022, the rating agency Demotech, which was at the time the primary financial strength rating company for many small Florida-only insurers, announced it was considering downgrading the ratings of more than 24 companies over concerns about their surplus and liquidity. A downgrade below a certain rating threshold matters because mortgage backers like Fannie Mae and Freddie Mac will not accept insurance from a company rated below that level, which can put homeowners at risk of losing their mortgage eligibility if their insurer is downgraded. Several companies, including United Property and Casualty, Florida Farm Bureau, TYP TAP, and others, either failed, stopped writing new business, or withdrew from the Florida market entirely during this period. This is part of why Florida's homeowners insurance premiums reached an average of roughly $8,700 per year by 2024, more than 3 times the national average at the time. Florida's exposure to hurricane risk is not new, and building codes there have already adapted to it once before. After Hurricane Andrew struck South Florida in 1992 and caused catastrophic damage to homes that were not built to withstand its winds, the state significantly strengthened its building codes, requiring stronger roof-to-wall connections, impact-resistant windows in some areas, and other wind mitigation standards for new construction. Homes built under these updated codes have generally performed better in subsequent storms than older homes built before the reforms. This shows that hurricane risk itself is manageable through stronger construction standards. The more recent insurance crisis has been driven less by an inability to build resilient homes and more by the financial and legal structure surrounding how insurers are allowed to price and defend against claims. California's FAIR Plan has faced a similar test of its own design limits. It was created decades ago specifically as a shared risk pool funded by the insurance companies operating in the state, meant to provide basic coverage to homeowners who could not find it on the private market, typically because of unusually high risk in a small number of locations. It was not built with the assumption that it would ever need to cover a large share of an entire state's high-value real estate. As wildfire risk has grown and private insurers have pulled back from broader areas rather than a small number of isolated properties, the FAIR Plan has absorbed far more policies and far more total financial exposure than its original design anticipated. This mismatch between the plan's original purpose and its current scale is part of why regulators and researchers have described its growth as a warning sign rather than a solved problem. Both states illustrate the same underlying tension, even though the specific triggers differ. Insurance is built on the ability to predict risk and price it accurately. In California, a rate approval law originally designed to protect consumers ended up limiting insurers' ability to price wildfire risk using modern tools, which pushed many of them to reduce coverage or leave rather than sell policies they could not accurately price. In Florida, a legal environment that allowed extensive, costly litigation drove up costs far beyond what hurricane damage alone would explain, again pushing insurers to pull back rather than absorb losses they considered unsustainable. In both cases, the companies that remained active worked to shift risk elsewhere, either onto state-backed insurers of last resort or onto higher premiums for the homeowners who could still get covered at all. This is why so much homeowner insurance coverage in high-risk areas of California and Florida has shifted onto state-run plans that were never designed to carry that much of the market. Both plans depend on either charging enough in premiums to cover a major disaster or spreading losses across the wider insurance market through assessments if a catastrophic event exceeds their reserves. If a severe wildfire season in California or a major hurricane strike in Florida overwhelms either state plan at the same time private capacity remains limited, the financial strain would not stay contained to homeowners in those specific risk zones. It would extend to insurance customers and markets well beyond the areas actually affected by the disaster itself. In both states, homeowners are left navigating a market shaped by decisions made years or even decades before the current crisis became visible. California's 1988 rate law was written before modern wildfire modeling existed and before the scale of today's fires was something regulators had reason to plan for. Florida's litigation rules were written to make it easier for policyholders to challenge insurers in good faith, not to create a financial incentive structure that a segment of the legal and contracting industry would later use at scale. Neither state set out to create an insurance availability crisis. Both are now working to unwind rules that made sense under different conditions, while millions of homeowners wait to see whether private insurers return to a market they left or whether state-backed plans that were built as a temporary backstop become a permanent part of how coverage works in high-risk parts of the country.